the sort of $1.4 trillion worth of refinancing and so forth. That's sort of gotten out of the news. We're not hearing about that. But if we look ahead, the best year, the highest pricing in real estate acquisitions and investment is sort of the 2005, 6, or early 7. And so those are loans that could potentially be coming due in 2015, 16, and 17. Do we have a whole new sort of crisis on our hand with properties and loans maturing, not enough capital, or underwater because of where they need to be to refinance? I mean, is there a problem lurking out there, or is there enough capital? Has there been enough growth in income in these properties that they'll be able to refinance themselves in the future?
I think you've got, by some charts you'll see commercial real estate values in the U.S. have almost fully recovered two peak values from the trough. But that's very widely stratified. So you have office in New York, for example, which is probably by some measures exceeding valuations in 2006, 2007. Multifamily across the country is approaching or exceeding valuations in 2006, 2007. Suburban office is still probably 30 to 40% below peak values. So it's widely stratified. But I would echo some of the sentiments that were made on this panel. We've been through a lot of those refinancing issues, term default issues over the past 3 or 4 years in less liquid lending markets, less demand to supply credit, and it worked out one way or another. I think there's more availability of credit today. There's more capital seeking real estate investment in the States. I don't know, maybe than ever before right now. So I think it's an opportunity for again, everyone up here on this panel, everyone in this room. I don't really see it as a massive risk. I don't think it's a black hole that we're stepping into.
Yeah, I would say that you have to look at the sales market. So I think this year there'll be $300 billion in sales, commercial property sales. It's up about 30% from last year. So while there may be some assets that can't be refinanced by their existing owners, doesn't mean they can't be sold at probably above the debt price, and the new owner can figure out the right capital structure. I think that's more likely to happen today than 2-3 years ago when those loans were coming due and there was neither capital nor buyers. So,
and the lender could afford to sell it, which they couldn't in 2008.
Big difference.
Yeah, I would agree. I wouldn't view it as a problem. I think it is an opportunity. I think by our numbers, we're probably pretty consistent with Deutsche's, it sounds like. But between 2/3 and 80 or 85% of the loans over the next 3 years can refinance at current levels. For those that can, there will be transfers of ownership, there will be recapitalizations, but there is a lot of capital. There's transparency as to the cost of debt right now, as to where NPL demand is. So with all of that clarity and how deep and liquid the market feels right now, it feels like it'll be pretty orderly, and again, an opportunity for those that want to either buy assets or lend versus those purchases.
The number of conduit lenders have increased this year over last year by 5 or 6, pretty significant participants. And if you look historically, in 2007, commercial banks were roughly $100 billion of originations. The CMBS market was $230 billion. And insurance companies are always kind of seem to peak around $50 billion. The commercial banks are coming back tremendously, as Chip and Jonathan have talked about. And I think given how tight spreads are and how competitive the environment is, I do believe that the new product maturing, or the product maturing, will get absorbed. And hopefully it makes spreads healthy again for us originators.
Yeah, I think that's the opportunity. I think that's why we set up our business, is that we want to play in that restructure space. We've been playing in it since 2008. We did several billion of restructuring loans for the balance sheet side, and we're looking towards the capital market side. I think that's the opportunity. I think if everything was easy to underwrite, we wouldn't be able to compete with people using deposits as a capital cost. So that we're excited. That's why we set up our business, is that not all the loans underwrite, and a lot of the real estate is actually quite good. A lot of the restructuring real estate, we did 60 transactions. They've all paid. There's when you look at getting in at a lower basis, even though the borrower is cash starved, a lot of good things happen at a lower basis, at a lower price, versus the prices that people paid 2006, 2007. So it's an opportunity to get capital at a great return at a lower basis per square foot. And, you know, it's difficult to get in terms of the capital. It has to be unregulated capital that's actually taking those pieces between what would be 70 or 90% loan to cost loan to value.
Richard, you started off asking about sweet spots, and you know, the beauty of a CMBS loan is that it's tranched, and the person who appreciates that piece of risk most purchases that tranche of the loan, so it places risk in the hands of those who can either manage it best or appreciate it most. You know, what we're really seeing, you know, sort of is Mark and Greta and their firms, you know, there are different firms that have evolved that appreciate different types of risk. So Wells on his balance sheet is going to appreciate a certain type of risk. You know, Jonathan does structured stuff that's a different kind of a risk. Mark, Greta, you know, so I mean, I again come back